In Japan, high savings rates had gradually led to excess funds available for speculative investments. Between 1986 and 1990, the Japanese economy supported economic bubbles that successfully inflated stock prices and land prices. History records reveal that stock market indices in Japan have witnessed an 800% jump in just 15 years. Japan's real estate industry was politically very powerful. Low interest rates created real estate bubbles that encouraged speculation. With ruthless speculation, the price of real estate in Tokyo ripped through the roofs. With the economic bubbles, the Japanese added more fizz and sparkle to stock market transactions. In the last century, over half a dozen economic institutions in Japan have collapsed. However, Japanese society sees these casualties as a part of healthy competition in everyday life. Every year, thousands of factories in Japan shut down due to ruthless competition. Economies might actually chug along better with a small string of bubbles. Therefore, the American Federal Reserve seemed open to the idea of making the economy run with a precise set of mathematically stacked bubbles. The Federal Reserve and the banking cartels helped create economic bubbles, periodically raising and lowering interest rates. The pivotal idea is to create containable bubble cycles within well-defined parameters. Perhaps it was believed that containable bubbles would initially provide a positive impetus to the economy and later deflate without explosive violence. Bubble economies typically run through a course of 14 years. However, midterm catastrophes may occur after the first 7 years. A successfully run financial bubble scam can run undetected for a period of 14 years. The Enron scam and the real estate bubbles went undetected for several years when the financial markets had been following an uptrend. History reveals that economic wrongdoings do not get exposed when financial markets are bullish and everyone is comfortably making money while riding on the waves of optimism. Scams generally get exposed only during downturns. Federal regulators appear to become more vigilant when the economy becomes unstable. President John Kennedy was deeply suspicious of the Federal Reserve. In a vicious power struggle, the Federal Reserve had taken away vital powers from Congress in matters relating to the supply of money. John Kennedy abhorred the idea of the Federal Reserve consorting with Wall Street banking mammoths to control the supply of money. After John Kennedy was assassinated, the Federal Reserve became an institutional apparatus utilized by the banking giants to fabricate public perception and create economic illusions. In America, stock market crashes are typically engineered to occur in February, March, June, and September. Some Western economists feel that the thrift practiced by Asian nations are partly responsible for the financial crisis in the West. Emerging Asian economies experiencing high growth rates and high incomes began living frugally and stashing away enormous sums of money. Wealth accumulated through savings was then channeled into speculative investments in real estate, the stock markets. Some Asian money was also funneled into America and Europe. The scene was now set to create economic bubbles. Quite simply, many banking institutions in America collapsed under the psychological weight of all this money. Perhaps Wall Street handled the sudden influx of money from Asia in an irresponsible way. They gambled recklessly with the foreign money. There are financial tycoons in Wall Street who know how to navigate adeptly through economic bubbles and become richer. At the time of World War II, Japan and Germany were America's worst enemies. After the Great War, however, bankers in America, Japan, and Germany shook hands and became partners in business. After World War II, Japan and Germany poured money into Wall Street to create economic bubbles. Wall Street became the preferred venue for orchestrating billion-dollar financial scams with a transcontinental footprint. This scam structure was devised intentionally by an international cartel of bankers, business tycoons, bureaucrats, and politicians. Swiss banks were part of an extensive international setup to carry out large-scale money laundering in complete secrecy and silence. What the Federal Reserve projects as sound fundamentals for a stable economy may actually be unsound in reality. Research shows that stock market crashes have occurred despite low inflation, low interest rates, and low unemployment levels. This suggests that the mere presence of sound economic fundamentals do not ward off stock market crashes or obstruct the generation of economic bubbles. In economics, the solutions evolved by academic researchers are themselves a part of the problem. For the sake of analytical convenience, academicians try to construct economic theories by examining demand and supply factors. While doing so, they conspicuously ignore the influence of popular perception. This is primarily because demand and supply issues can be quantified to easily fit into a mathematical equation, while perception cannot be quantified. In the real-world scenario, however, public perception, sentiment, and mood play a major role in engineering economic upturns and downturns. Sometimes, these mood changes can be ruthlessly sudden. When Wall Street investment banks became aware of falling real estate prices and rising mortgage defaults, they did not stop selling risky securities as good corporate ethics would normally demand. Instead, they evolved outrageously clever money-making schemes. Investment banks would intentionally mislead institutional investors, sell them risky securities with toxic levels of subprime mortgages, and then bet on them defaulting. Sometimes, institutional buyers of these risky securities were not informed of the toxic subprime mortgage content. At other times, institutional investors were forewarned. Shrewd investors who could foresee subprime defaults would intentionally purchase securities backed by risky mortgages and make money by betting against them by purchasing insurance. Moreover, ratings were often assigned without adequately verifying data on mortgages. Banks were not really sure if combining risky mortgages would reduce risk or increase risk. However, they were able to make credit rating agencies believe that combining risky mortgages would reduce risk. The credit rating agencies were private entities, but the ratings were accepted by federal authorities. Somehow, in this system of chaos and anarchy, AAA securities might have got created from a pool where the components might never have individually qualified for AAA rating. Intuitively, it is doubtful if credit quality could be enhanced above that of the original pool. CDOs with inflated ratings were quickly bought by European investors who knew very little about the mortgage market in America. What derivative financial instruments did was encourage speculation and make the financial space more risky. Lending to people with poor credit did not seem like a bad idea. Many of the financial risk models based on probability theory might be flawed. Time and again, these exotic financial models attempt to create illusions of profit. They also insidiously provide the tools and operational framework for certain types of fraud that cannot be easily detected by regulatory authorities. Mathematicians had perfected the art of concealing financial risk while embellishing it with complex probabilistic theory. These mathematicians provided the tools to deceptively make risky collateralized debt obligations seem on the surface as safe as U.S. Treasury bonds. Through complex arguments written with mathematical theory, they also managed to deceive the rating agencies. Meanwhile, the vast majority of Wall Street investors neither had the information nor the intuitive intelligence to accurately judge risk. In many instances, investors were planning the buying based on incorrect ratings. Even within Wall Street investment banks, senior executives were not aware of the risk they were exposed to. Information pertaining to risk was quietly withheld by the middle management before it reached top management. There was something inherently wrong in the way rating agencies conducted their operations. In some ways, the rating agencies themselves were part of a big problem within American capitalism. The American government and the regulatory authorities probably know this very well, but intentionally chose to look the other way. It is often alleged that rating agencies gave away AAA ratings in exchange for a fat consulting fee. When audit firms began looking at the balance sheets of AIG, they were stunned and horrified. In a shady practice, the subsidiaries of AIG were granted AAA rating based on the financial credentials of the parent company. Prestigious Wall Street banks were selling subprime mortgage-backed securities and simultaneously betting against them through a variety of financial instruments. The SEC had been unable to crack down on this financial racket. A major bank had a hedge fund buy securities that were almost sure to default. The hedge fund bought insurance against default, knowing that a default was imminent. When the security eventually defaulted, the hedge fund collected piles of money from the insurer. Though the SEC charged the bank with securities fraud, it did not have the powers for prosecution. Regulators such as the SEC and Commodity Futures Trading Commission (CFTC) could only bring civil charges that could result in simple fines. In America, the Federal Reserve Administration and investment bankers were overly dependent on mathematical models that did not reflect economic reality. The key reason for the financial fiascos in America was a financial experiment that failed due to flawed economic modeling. Perhaps banking is one industry where the application of free market theories can be very dangerous. Sometimes, the Federal Reserve lowers interest rates to stimulate spending. When Alan Greenspan had the Federal Reserve reduce interest rates continually, real estate businesses started picking up. Home prices began to rise. The Federal Reserve was wrongly attributing the rise of home prices to a strong economy. The reality was different. When the interest set by the Feds was below 3%, speculators started borrowing money. The speculators in question included subprime home buyers, mortgage finance companies, and hedge funds. Transactions were being carried out with dangerously high levels of leveraging. This led to a credit bubble. Banks obtained short-term loans by offering some assets as collateral. A borrowing bank can sell securities while making a promise to repurchase the securities at a later date for a specific sum of money. In such transactions involving securities, the borrowers and sellers are exposed to risks associated with interest rates. In effect, the incremental difference between the selling and repurchase price would represent the interest on a loan. American credit rating agencies played a key role in misguiding investments and precipitating the financial crisis. Essentially, investors who had based their decisions on the data made available by rating agencies suffered losses. The subprime crisis and the federal bailouts were all a part of American capitalism. For about 4 uninterrupted years starting from 2000, real estate prices began increasing sharply. In fact, between 1997 and 2005, home prices recorded an astonishing 80% increase. This began attracting speculative investments in real estate. As the prices of homes were steadily rising, obtaining a loan for investment in real estate became relatively easy. In this scenario, the banking cartel in America had decided that creditworthiness should not be made a major issue for new borrowers. However, by about 2005, public sentiment began to flutter. By 2006, real estate prices started going down sharply. In 2007, over 1 million homeowners initiated foreclosure proceedings. Meanwhile, about 10% of American homeowners saw their equity eroded significantly. Many started defaulting on the loans. The complex chain of events following speculative investments in real estate had by now begun to create a serious credit crunch. According to economists, mortgage defaults could occur when interest rates skyrocketed and the economy slowed down. In 2006, none of the above was actually happening. It was not clear why borrowers were defaulting in large numbers. Anyway, when the first signs of mass default appeared on the landscape, banks offloaded risk by turning to credit default swaps and derivatives. Essentially, Wall Street banks continued to hand out risky mortgages and purchase insurance against default. Merrill Lynch, Citigroup, Countrywide, and AmeriQuest were heavily into mortgage lending. Mortgage brokers were not regulated by the Feds. While the Feds were busy supervising big banks. The Treasury Department supervised the nationally chartered banks. The FDIC regulated the smaller banks. Mortgage bankers operated at the state level and were essentially beyond the outreach of the feds. This was a weak link in the financial system. In the last century, homebuyers and real estate developers were experiencing a severe scarcity of funds. The new range of financial instruments had evolved to allow borrowers and lenders to interact more directly.